Picture this, your partner passes away next Tuesday. The funeral's handled, the cards are sent, and then the mortgage comes out. Do you actually know if you'd be okay? Most people that I talk to say they think so, but think really isn't good enough when your family's on the line. According to a 2025 Policy Me Canadian life insurance statistic, 42% of Canadians have no life insurance at all or have no idea. And among those that do, a significant portion of them are actually underinsured compared to their income and debt obligations. That means that millions of Canadians are playing a very expensive guessing game. Now, I want you to meet Mark and Laura, a very young couple who came to us. They have two kids, ages 4 and 7. They have a mortgage of $480,000. Laura works part-time so she can handle the school pickups. And Mark, he works a full-time job making $95,000 a year. Mark had a $250,000 policy through work. It felt solid. Then Mark got laid off out of nowhere. The policy, it's gone. They came in with zero coverage and had no idea. We rebuilt their plan. $750,000 in term coverage for Mark, $400,000 in coverage for Laura, all for about $130 a month. That's less than their Netflix, Spotify, and gym memberships put together. Now, how can we figure this out on our own at home? I like to use the DIME formula. D stands for debt except for the mortgage. So that's $22,000. I is for income replacement. We like to do 10 times the salary. So that's $950,000 for Mark and Laura. M is for the mortgage. That's $480,000. And E is for the education needs. We'll say about $50,000 per child for $100,000 for this family. That's a grand total of $1.55 million in coverage. Now, the important thing to take away isn't that we have to hit every single dollar of that, but it gives us a way better starting point than just picking a number that might sound big enough. It avoids over or under insuring by a large margin. Two of the biggest mistakes that I see every single day are assuming that your group benefits are enough. What a lot of people don't realize is that if you leave that job, your group plan doesn't follow you. Plus, at retirement, it's gone. The second one is only protecting the breadwinner. By only protecting the breadwinner, we often forget that the stay-at-home costs are roughly between $50,000 to $80,000 a year if we count things like childcare, housekeeping, appointments. So here's what I want to take away from today. The right number isn't the same for everyone, and it changes as your life changes. When you have another kid, pay down debt, or one of you stops working and loses your job. The same goes for if your kids move out and whatnot. This isn't just a set it and forget it decision. It's a 20-minute conversation that most families are putting off because it feels complicated. But in reality, it's not. You just need someone to walk you through your actual numbers. No assumptions, no guessing. So if you were watching this today and thought, I genuinely don't know if we have enough, then that's actually probably the most useful thing that you could take away from this. That feeling is worth acting on. I do free 20-minute clarity calls where we take a look at your actual situation, your mortgage, your income, your kids. We figure out your specific number and what makes sense for your family. No products, no pressure, just straight answers. The link to book is right below this video. Grab a spot when you've got a quiet 20 minutes and the kids are in bed. That's all it takes. Take care of your financial future today. It's going to be the most important thing. Your future self will thank you for it.